We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Rick Rule, investor, speculator, and founder and CEO of Rule Investment Media. Rick, thanks so much for joining me today. It's always a great pleasure to speak with you.
Tom, the pleasure's mine. Thank you for having me back.
So, Rick, I wanted to start today by asking, what are some of the most important things that you have maybe come to change your mind on in the past years through lessons learned, whether that's through lessons learned by reviewing tape from your conferences that you have, through conversations that you have with, people in the industry? What are a couple things that you have really maybe been struck by that you have changed your mind about?
I think with regards to money, patience is the first. You would like, of course, to have confirmation of your investment thesis in the near term, but it isn't normally offered up in the near term. And as Warren Buffett points out, a pretty good investor, as you know, that the first wonder of the financial world is compounding. If you don't have patience, you can't enjoy compounding. Compounding seems like a strange concept with penny exploration stocks. But the truth is that the path to discovery may have 10 or 12 steps. If you get the first step right, you need to ask yourself about the second step, and then the third step, and the fourth step, and the fifth step. So compounding is important in penny stocks too. When I look back at my career over those 10 baggers I've enjoyed, or 20 baggers, or even 100 baggers, what I find is that although I wanted performance in the near term, it took me an average of 5 or 6 years to enjoy 10 baggers, to the extent that in my mind, I had a frame of reference with regards to time that was incorrect. I was my own worst enemy. Mm-hmm. I would say the second is persistence and tenacity. That same quest for 10 baggers has in almost every case exposed me to a 50% decline in the share price of a stock when I was holding it. If I liked it at $2, I better like it at $1. I better revisit my premise, mm-hmm. but I better like it again. I would say, and this is in no particular order, but the third is really the importance of people. People in two senses. We've talked on your show before, Tom, about Pareto's law, about the so-called 80-20 rule, how 20% of the people generate 80% of the utility, mm-hmm. How a different 20% of the people generate 80% of the aggravation, and the importance of hanging out with the good 20 rather than the bad 20. We've talked, too, about the fact that if you put the good or the bad lip through the same performance dispersal curve, that they conformably align, which is to suggest that 20% of the 20% do 80% of the 80%. So 4% of the population generates 65% of the utility. That's important. Mm-hmm. But there's another thing about people. Bad people wreck great deals. I was told once by a pretty good speculator that the rocks didn't care who owned them, and that I needed to be, how would you say, a bit more tolerant about who I hung out with. That turns out not to be true. High-quality people generate high-quality outcomes. They are more likely to come into contact with good rocks, and they are more likely to care about treating other people well. Some years ago, I remember getting a phone call from a woman who was a receptionist, the lowest paid person on the payroll at Silver Standard, thanking me for my efforts around Silver Standard and telling me that as a consequence of the stock options that Bob Quartermain gave her, as opposed to keeping them for himself, that she was able to put down a down payment on a condo, something that otherwise wouldn't have been available to her. Mm-hmm. Now, while that speaks volumes about what a good person Bob Quartermain is, it also fosters the wonderful team who when it is necessary, is willing to put in 14 hours or 16 hours for the benefit of the team. So it turns out that people have to be not merely competent, but good. I think the last thing I need to say, Tom, and it's been a strategy of mine for a long time, is that in capital-intensive cyclical businesses, you have to be a contrarian or you're going to be a victim. You have to buy stuff when it's out of favor, and you have to buy markets when markets are in disarray. I've come really, truly to love hate. I look through social media commentary in areas that I'm close to, and I look for a preponderance of negative sentiment. I know, as an example, that the sentiment that surrounded the silver trade after the sort of bust of the so-called silver squeeze was extremely bullish. There's no hatred as sincere as the hatred of a jilted lover. And all the hate that silver experienced after the silver squeeze didn't materialize meant that the last seller had already been squeezed out of the silver juniors. It's odd that you look for hate as a leading positive indicator, but I've learned it's absolutely positively the case. That's probably enough pontification from me. There's enough there for people to chew on. And there's enough there that's challenging. People want, not that it matters, they want stuff to take place in a short period of time. Turns out the cosmos doesn't give a damn what we want. There's a temptation to hang out with bad people because they're easy to find than good people. You want confirmation. You want a narrative that proves to be true sooner rather than later. And again, the cosmos couldn't care less what you want. So it's important to adjust your preferences for the realities on offer.
Yeah, I like the way that you put that. Be a contrarian or be a victim. That is, I think that's a very succinct way of putting it. And Rick, that's the idea of hanging out with the right people or surrounding yourself with the right influences is something that I have really been thinking a lot about lately. It's, as you say, it's so easy to fall into this trap of being around, easy people to be around. It's much harder to find those quality people. And that's absolutely something that I think is very key to be successful in many facets of your life, not just in the markets that we're always looking at.
Of course, I'm tempted not to give people advice. It's non-financial, and I agree with you.
So, Rick, with so much speculation and unknown around the election coming in November, should people be far more focused on expressing their will through markets rather than governments?
That would be my preference, of course. It seems that people have a strange relationship with politics. I always loved the incorrect quote that politics is defined by an examination of the root words. Poly, of course, from the Greek for many, but tick from the English colloquial for small blood-sucking insect. And if you look at the process as a war between many small blood-sucking insects, I think you begin to understand the nature of the beast. What many people regard as needless interference in their lives, they are happy to impose on other people. What is for one person waste and fraud and abuse in government is for someone else a needed program. And I think that the world would be a much better place were people to look after themselves and the people that they knew well, and be less inclined to favors from society or attempt to impose their preferences on other. There are three major candidates for the U.S. election. This will get me a lot of hate in the comments. And I wouldn't vote for any of them. I regard them as Tweedledum, Tweedledummer, and Tweedledummest in no particular order. I'm interested in people who would like primarily to leave me alone, leave me to my own devices. I would rather do business with people who had to convince me to consume their products rather than coerce me to pay taxes. I prefer to be convinced, as opposed to coerced. Now, that's not on offer. So I think it's also important for people to organize their lives in a way that they bear as little consequence of elections as is possible.
So, Rick, what do you see as the biggest obstacle in the way of this, of people expressing their will through the markets? Do you think it's education?
Partially education, but I think people have come to believe that society owes them something. In a market, you have to take responsibility for yourself. It's easier to blame society. It's easier to suggest, I am owed this. When I look at, well, a related quote, I think it was Buffett. It was either Buffett or Munger who described markets as being in the short term voting machines and in the long term weighing machines. Mm-hmm. And he said, if you're comfortable with the way people vote, you can look at markets from a short term perspective. Mm-hmm. I think that's a very ironic quote in the context of what we're talking about. Mm-hmm. People pay an awful lot of attention to a lot of big picture stuff that isn't necessarily particularly relevant to them. People have opinions about politics. Opinions in markets are very dangerous. Paying attention to narrative that's ill-founded narrative, that narrative that hasn't been investigated, is the stuff of losses. Politics is, in a sense, easy. You can park yourself in front of a television, listen to a commentator who's a wonderful wordsmith and doesn't know very much about anything. Form your opinion on 65 seconds of hyperbole and express your opinion in the polls. Too many people do the same thing with regards to markets. Too many people's approach to markets has got a hunch, bet a bunch. An ill-founded approach at best. And I suspect that those people enjoy the same success in the market that they do in politics, which is to say, not very much.
Rick, as we're thinking about being contrarians, one thing I've been, aware of as I speak to many people in our space is, or was this kind of consensus that many basically viewed this inevitability of a recession during the last 2 years as a foregone conclusion. So what do you make of the prospects of a recession, both in the US and worldwide at this point?
I regard it as more likely than not. I've been through a lot of them. Mm-hmm. And I've learned that at age 71, I'll come through the backside of this one too. And what it means is that while I have to think in a shorter term context, I have to act in a longer term context. Tom, an interesting illustration of this was provided again by Warren Buffett, who pointed out that during his years at the helm of Berkshire Hathaway, something like 50 of them, that 4 or 5 times during his period, that the share price had declined by 50% or more in an 18-month time frame. Mm-hmm. If you look at a stock chart of Berkshire Hathaway going back to 1966 until today, you can't see those declines. You literally can't see those declines. Mm-hmm. I proceed under the assumption that sometime in the next 5 years, some event, liquidity squeeze, recession, whatever, will occur, and it will take equity markets down by between 30 and 50%. Mm-hmm. Now, I have 2 choices. I can stay out of the market, or I can maintain enough liquidity and have a high enough quality portfolio that my portfolio A will come back, and B, I can use my liquidity to buy other people's mistakes. For people who use the fear of recession as an excuse to stay out of the market, those people will consign themselves to performance mediocrity over time. A recession or some form of setback is an inevitability. Mm-hmm. if you are going to try to get ahead, there is absolutely no way that you can get ahead without accepting those periodic risks. Bernard Baruch, I think, boy, I'm full of quotes this morning. Bernard Baruch once said that the only guy who ever bought at the bottom and sold at the top was a liar. It didn't happen.
And especially if he did it repeatedly. You know, Rick, as we're talking about Warren Buffett, it occurs to me that, you know, an argument could be made that at times he did not adapt properly to, you know, new, maybe even whether it was new systems, new paradigms of growth versus value, and he really stayed in this value mindset. So I just want to get your take on understanding the idea of maybe trying to invest in businesses that you know very well, and how you balance trying to take in new information and account for changes in the world as they come.
Well, first of all, I no longer invest outside of natural resources and conventional financial services. Mm-hmm. There's all kinds of cool sounding stuff out there, but I don't know how to know it's true. Mm-hmm. And there is enough opportunity for me in subjects that I have 50 years of experience in that I don't find it necessary to relearn the lessons that I learned by making mistakes in resources and conventional financial services mm-hmm. in the first 10 years of my career. And I would suggest that that's what Buffett says. What Buffett says is if he doesn't understand it, he doesn't want to do it. He points out that he's made enough mistakes and stuff he understands that there's no particular need to go outside of his circle of competence and find ways to make new mistakes. His methodology is very much finding fairly dominant businesses that have good margins, can use leverage, but employ it only modestly so that they can lever up their balance sheet in bad markets and expand. And companies who are tax efficient to the extent that they return capital to shareholders via share buybacks as opposed to dividends. Mm-hmm. That's a wonderful strategy. There are people who point out that other people have got richer quicker. What they don't point out is that those people who got richer have not given over half their net worth to philanthropy yet. Buffett's third in the list because he's given away half his net worth. And what he has been able to do has entailed substantially less risk than what the other guys have done. It is important not just to look at who made the most money, because if you're trying to apply that to yourself, all of these guys are smarter than we are, and they all work harder than we are. What's important to me is risk-adjusted returns. And in terms of risk-adjusted return, because Buffett eschewed risk, the returns that he's generated on a risk-weighted basis are way better than the other guys. I mean, there's no comparison.
Mm-hmm. Well, all that being said, Rick, how do we account for the fact that he says gold is just a stupid pet rock?
Maybe he's right. Maybe he's right. Mm-hmm. Buffett has also said he doesn't need gold. And I think that's a much more important statement. If you look back to the decade of the 1970s, when gold, of course, did extraordinarily well, what Buffett pointed out was that high-quality companies that had operating leverage, that could increase their prices, that were price makers, not price takers, were great hedges against inflation. Companies that had to invest a whole bunch of money in property, plant, and equipment were stymied by inflation, but companies that had already established those positions weren't. Mm-hmm. I guess what I'm trying to say is Buffett is smarter than I am, so he doesn't need gold. I'm not as smart as Buffett, so I need gold.
That's a really interesting way to look at that, Rick. I think that's it's I guess an admission of humility on your part, but an interesting answer nonetheless.
Listen, I mean, I've studied what he does. and I've studied it carefully. I haven't just read every shareholder letter and every annual report. I've read them in some detail. And he tells you very, very, very clearly how he does what he does. And much more importantly, he describes in gruesome detail his mistakes. As an example, his forays into airlines. Having seen that, would I have identified Coca-Cola as an investment at the time he did it? Would I have been as sophisticated as Warren Buffett was and as able to utilize the methodology that he utilizes to achieve the same results? Probably not. Probably not. That's why I've chosen to stick to industries that I know very, very, very well. After 50 years in the business, I understand what makes a good oil company, either a major producer or an explorer. I understand what makes a good mining company. I understand how the timberland cycle works. I understand how some farmland cycles work. I understand community banking. I understand the insurance business. Within my own circle of competence, there is more opportunity than I will possibly be able to access for the rest of my life. So my temptation to go into stocks that would require a knowledge of popular culture, let's say communication stocks, or technology stocks, or cryptos. I hope people make trillions there. I have no fear of missing out, and I have no envy of other people's success. I want to make reasonable amounts of money for the rest of my life. By the way, my wife and I, second to die, will basically give away our entire estate to philanthropy. So I'm doing this to give away more, not to live better. But the truth is, there's all the opportunity I need within my circle of competence.
Rick, do you think that the world is returning to gold as the best neutral bearer asset, and will it continue to outperform stocks and bonds here for the next foreseeable future?
The second part of the question, yes. For most of the world, they can't spell gold. It's important to us, but you and I live in an echo chamber, a golden echo chamber to be sure. But we live in an echo chamber. The market share of precious metals and precious metals related assets relative to other savings and investment asset classes worldwide is about 1%. In the US, it's only 0.5%. In terms of most people's psyche, gold isn't even a floating abstraction. They don't know that it exists. And that's part of the opportunity, because the second part of your question, I think, the answer to that is yes. Gold has done well during periods of time when there was uncertainty around fiat-denominated savings instruments. Obviously, I believe that time is nigh. The 4-decade mean market share of gold in the U.S. is 2%, as opposed to 0.5% now. If the market's fascination for gold merely returned to the 4-decade mean, demand for precious metals and precious metals related assets would quadruple. And that's precisely what I think is going to happen.
As we think about the possibilities of something like that happening, Rick, do you think that there is a likelihood, let's say, for Europe to turn away from the US? Do you think that there is maybe a growing recognition that Europe, or by Europe, that they can be doing business elsewhere that would be more beneficial to them? And what do you think the impact of that would look like in terms of resource investing?
I suspect that the whole world would be better were it more multipolar. I think that the Europeans need to address their own house before they address us. I also believe that the US dollar will continue to be the world's reserve currency for my lifetime. For the record, I'm a very healthy 71-year-old. I think that US hegemony will become increasingly challenged, which is to say that I think with regards to stores of value and mediums of exchange, that the dollar will have rivals, gold being among them. I think even within Europe, that European peoples are becoming disenchanted with a forced level of government in Brussels, superseding the national government, regional government, and local governments. And so it isn't so much Europe becoming disenchanted with the United States, although I think that's in the offing. I think Europe is becoming increasingly disenchanted with Europe, or at least with regards to Brussels. And I think that Europeans likely and should look for multilateral relationships with the world. If the question goes specifically to Russia, I think that there is some sympathy for Russia among some European intellectuals. I think what you'll find is that the frontline states, as I recall, you're partly Ukrainian, have a deep distrust for Russia, which is to say Latvia, Estonia, Lithuania, the people in Belarus, if not the leaders, certainly the Poles, the Czechs, the Slovaks. It may be that countries that have less exposure to Russia fear it less. But those countries that have exposure to Russia, perhaps like those countries that have exposure to the United States, can and do fear it more.
Rick, when we think about holding precious metals related equities, how do you see the risk of, let's say, confiscation through a mechanism like what David Rogers Webb wrote about in The Great Taking?
I think very low. The US government can steal from you in ways that make them popular. Artificially low interest rates, that is the Fed manipulating interest rates down, penalizes savers and benefits spenders and investors like myself. The Fed, through inflation, can devalue the nominal consideration that one receives for Social Security, Medicare, Medicaid, things like that. To the extent that they foster inflation, to the extent that they manipulate interest rates lower, they're popular. They don't need to steal your gold. They don't need to steal your IRA. Increases in tax, allegedly on the rich, are inevitably popular. It's theft. So I don't think that the government needs to steal from you overtly, because stealing from you overtly constitutes risk. You could vote them out of office, or remember, there's probably 400 million guns in private circulation in the United States. That's a real risk. There's a bunch of folks out there who know how to use them. You push them too far, things get real ugly. But if they steal from you for imposing idiotic regulations, or changing taxes, or promulgating inflation, or artificially low interest rates, all those are theft. All those are confiscation, but that form of confiscation makes them popular.
At least among a different subset of people that don't necessarily understand it.
A very large subset, Tom. Yeah. Very large subset. I described the three candidates for president as Tweedledum, Tweedledummer, and Tweedledummest. Were I to run against those four, I would finish so far down the polls as to be a floating abstraction or an irrelevancy. By the way, were I elected, I would demand an immediate recount.
Yeah, but just imagine what the country, how much chaos would ensue after you were elected, Rick, and then what that rebuilding process would look like. You know,
as Doug Casey says, it would be fun to watch on a broad screen TV from somewhere else.
Yeah, absolutely. Rick, one of the last times we spoke, you said that you were loading up on uranium producers in anticipation of part of the run that we've experienced over the last year here. So where do you think we are in the uranium cycle at this point?
Well, pretty clearly the easy money's been made. Mm-hmm. You know, a basket of juniors purchased the first time that you and I talked about uranium in 2022, probably up 400% or 500%. I mean, stupid numbers. I've taken my money off the table. I haven't sold all my uranium juniors, but I sold enough that I have no net investment in them, including selling enough to pay the capital gains tax. I think the big money is ahead. Well, not the big money. I think the sure money is ahead of us because the emergence of a term contract in uranium means that uranium producers can lock in prices and quantities with investment grade counterparties for as much as 15 years. You can't do that in any other commodity. Mm-hmm. And as that certainty around revenue and less so around margin materializes, the debt cost of capital to uranium builders that have a price locked in for 15 years is going to be 300 or 400 basis points lower than any other commodity. This is stupid. Two, lazy old securities analysts like myself, when you look at a development stage project over 15 or 20 years, you're trying to do a net present value, and your price calculations are all guesses in every other commodity market on the planet, except for uranium. Their equity cost of capital is going to be less. It's going to take 2 or 3 years to work its way through because right now those term contracts are opaque. The companies, for competitive reasons, aren't disclosing them. The companies that do disclose them will have lower costs of capital, which means 5 years from now, while there might not be a uniform reporting requirement for those contracts, there will be voluntary reporting because the companies that accurately and voluntarily report will have higher share prices than those that don't. Mm-hmm. So while the big money has been made, the sure money is ahead of us. You know, we have a circumstance now where developers, the next gens of the world, the fissions of the world, the Boss Energies of the world, the Deep Yellows of the world, people who wouldn't have been able to build mines on their own account 10 years ago because they didn't have access to on-balance sheet investment grade credit, will be able to do it. If you have a turnkey contract to build your project, even if you pay a bit too much for the insurance of a turnkey contract, while at the same time you've locked in the price and terms for a substantial amount of your production with an investment grade counterparty, a Tokyo Electric Power, a China General Nuclear, a Duke Power, a Southern company, you can literally take that to the bank. Companies that didn't have a prayer of building projects will be able to build projects. And the fact that they can build them means that they'll be more powerful in the merger and acquisition market, where they say to an acquirer, if you pay up, we'll sell. If you don't, we'll build. And the will build threat has credibility now. Mm-hmm.
You know, with the news of the FDIC coming today announcing that lenders are on the brink of insolvency, Rick, $517 billion of unrealized losses hitting the U.S. banking system. Do you think that the next wave of the banking crisis to start as the higher interest rate environment that we are now in starts to catch up with some of this maturing debt?
Yeah, I think so. I mean, as you know, I'm in front of the FDIC right now, starting a new bank. And they have said, without saying it, your application is going a little slow because we have other concerns. You know, looking backwards, Silicon Valley Bank, Sovereign Bank, First Republic Bank, all these kinds of things. There's enough confidence in the system right now, Tom, that we aren't at a crisis point. Mm-hmm. Americans still believe in too big to fail. They still believe that perhaps what they do is they shift their deposits from community banks that pay them interest to great big banks that don't pay them interest for safety. And when I explain in lectures the fact that the U.S. banking system has too many long-term denominated assets, 7 or 8 year assets, funded by overnight liabilities, this mismatch of duration is what brought down the savings and loan industry. You know, I mean, it's a real problem, and it's a problem that's there today. I think probably we get through this. I think that you will see some smaller banks that succumb to commercial real estate lending portfolios and this mismatch. Make no mistake, if you own, 8 or 10 year long assets that you put in place in 2002, 2003 at half of today's interest rates, the FDIC isn't requiring you to mark those to market if you say they're held to maturity. But the truth is that what you pay for capital in the overnight accounts has doubled, while the net present value of your free cash flows as a consequence of today's higher interest rates is off by 20 or 30%. There are a bunch of banks in the US that are zombies. A lot of them get through unless, in addition to having this time mismatch, they have large commercial real estate portfolios, in which case they're toast.
So this risk that is now facing these banks, or the banks that are now facing these risks, that's not just due to a maturity mismatch. It's also due to their real estate, whether that be commercial or residential portfolios, is also a risk now.
Yeah, we aren't seeing the markdowns in residential that we're seeing in commercial. I mean, I've seen, fairly recently, hotels as an example that changed hands 4 years ago at $600 or $700 million, crossing off at 125. If the guy who bought that hotel had financed that $600 million purchase with $400 million in debt, the lender's been marked down 70%. The equity holder went to equity heaven. He's gone. And you are seeing about a year ago, I was in Midtown Manhattan, and I was in a second tier, Class B office building. And the office building was 12% occupied. They can't service the running expenses of the building, never mind the debt, with 12% occupancy. The lender is going to get that building back. And then the lender, in addition to having a non-performing loan, is going to have operating losses on his or her collateral. We haven't worked that through the system yet. Now, this isn't a circumstance that's going to bring down the United States. But it could easily be the circumstance that precipitates a 2008 style liquidity crunch. Doug Casey famously points out that a foreclosure doesn't destroy real wealth. The building goes away. The building doesn't go away. It just changes hands. It goes from dumb money to smart money. And nothing in the world pisses dumb money off than losing to smart money.
Again, another gem from you, Rick. What do you think some of the most important things that people should be looking for in a bank?
Ask the bank for the statement of financial condition. The FDIC requires that the bank give you a statement of financial condition. If they're public, get the proxy statement, get the balance sheet, get the income statement. I mean, first of all, banks are supposed to have money, right? The Fed suggests that a 7% equity slice is well capitalized, which means that 7% of total capital needs to be equity. I'm an old guy. I prefer 10. More money is better than less money. They are forced to explain to you the median maturity that they have on their asset class and whether or not they mark to market. It's good to understand that. But, Tom, right now, there is well over $1 trillion in deposits held by Americans in American banks that pays no interest, which is to say, separate apart from the big picture risk, there's a bunch of folks out there who have entrusted money to banks that pay them no interest whatsoever. The biggest risk that those depositors face is to the left of their right ear and to the right of their left ear. You can either get paid 2 or 4.3, or you can get paid nothing. If you're dumb enough to take nothing, the banks are going to give you that. Nothing. People don't do the work.
Well, Rick, in that vein, I've heard you say before that you're pro savings, but what advice do you have for people that want to save yet think that cash in the bank is a good way to protect their wealth or save their wealth?
You don't protect or save. Liquidity is something that you have to have but you have to understand it's a cost. People who look conventionally at the world today, Tom, believe that inflation is registered in the consumer price index, which is wrong. The consumer price index, first of all, is hedonistically adjusted. Second of all, when it's inconvenient, doesn't include food or fuel, which is problematic for people who eat. But most importantly, it doesn't include tax. I believe that the basket of goods and services I consume means that the purchasing power of my savings is declining at 7 or 7.5, maybe 8% a year. While I have substantial, and I'm making sort of 4.3, 4.4% on that liquidity, so I'm really losing 3% a year. I regard the loss in purchasing power as an option payment, because having the liquidity will allow me to take advantage of a liquidity shortage, a 2008 style event, rather than being taken advantage of, by it. I don't regard my savings as a store of value. I regard them as a necessary cost. I also personally regard my bullion as cash. Yeah, there's a lot of people for whom I don't think their bullion should be regarded by them as cash because they refuse to sell it. For them, it's a different asset class. For me, it's some of both. It's insurance, but I do know that there have been circumstances where other asset classes came to me to represent better value, where I sold some bullion and bought them. So for me, my gold is non-correlated cash, volatile cash, but good cash nonetheless.
Right. Rick, do you think that the US or Canadian banking system is better set up to handle shocks, or is one might be riskier than the other?
From a shareholder's perspective, the Canadian banking system is better because it's an oligopoly. Canada is a very underserved banking market. That means that system is more solvent because they're allowed to manhandle their depositors and their borrowers better. Having effectively 5 big banks in a market that's small, 7% of the size of the US market, but where you have very little competition relative to the US market, makes those banks much more profitable and much more solvent. The banking customer pays that price, of course. So as a borrower, as a banking customer, I would much rather be on the US side of the border. There is no requirement as a customer in the United States that you bank with an insolvent bank. There's plenty of great banks in the US. There are banks that they're financial fortresses. First National Bank of Alaska, Farmers and Merchants Bank of Long Beach, Bank of Hemet, just to name a few, where I'm a shareholder. There's no requirement as a customer that you have a business relationship with an abusive bank that doesn't pay you interest on deposits. There's no requirement that you be a shareholder of a bank that's lent long and borrowed short, which is to say, committed financial hara-kiri. But people who are unwilling to do the work are people who are going to continue to be impacted negatively by that. Why would somebody have a deposit that didn't pay them interest? This makes absolutely no sense. You take the on-lending risk of the bank, you take duration risk, you take credit risk, and you don't get paid. This is just phenomenally stupid.
I believe I remember somebody, very intelligent once saying that's return-free risk, right?
Return-free risk, exactly. Jim Grant was the author of that phrase. Wonderful guy.
Well, and I remember you using it several times, because again, I think that's a perfect way to frame a lot of these situations that, people don't necessarily actually take the time to think about properly.
Correct. There are institutions, including my new institution, Battle Bank, that will happily pay you interest on your checking account. Why would you give money to a bank and not get paid interest? I I don't know why people do this. Inertia, stupidity. It's a mystery to me. I actually don't know how to market to these people.
So Rick, are you guys still in limbo of FDIC approval? Where are you guys at with battle?
We believe we're in the home stretch, but one never knows until they say yes.
Right.
We've used the time well. When we started Everbank, which, as you may recall, we grew from zero to $28 billion over 14 years, we had no customers. We have almost 14,000 people now who have suggested that they want to do business with us. Mm-hmm. They want to store gold or silver with us. They want to borrow money against their gold or silver. They want to put money in certificates of deposit in a whole bunch of different currencies rather than just the US dollar. Something mundane is they want to get paid money on their savings. Mm-hmm. They actually want to receive interest. So we've done a very good job of that. But yes, we're still in limbo. And my suspicion is that the entire slowness with regards to the FDIC is they've been pretty busy the last 18 months. I don't forgive them this. I'm a taxpayer. I want my file to be on top.
Yeah.
But I understand, with their career risk, not dealing with First Republic, not dealing with Silicon Valley Bank, obviously those files were more important to them than mine.
Well, I would just assume that there are, more than enough people employed by the FDIC that, there's not the same 5 people looking after all of the same fires at the same time.
But I suspect that they, and I'm making this up now, Tom, mm-hmm. I suspect that they do look more carefully at crises, particularly big crises. And there are both big crises and small crises in the country. So when I talk about the fact that there's lots of good community banks, there's lots of bad ones too. Mm-hmm. And I think in the back of their minds, they think about the crisis of confidence that would occur. As an example, if Bank of America had to market all those loans and bonds that they regard as held to maturity. Mm-hmm. If Bank of America were allowed to wobble, the impact on investor confidence in the United States would be a truly, truly, truly strange thing to behold. And I think the FDIC is cognizant of that.
Rick, as we see more of the world come out of poverty, is it a reliable byproduct of demand that these people start needing things and wanting things that are made from commodities?
Absolutely. Absolutely. You have your finger really on that pulse. We've done a wonderful job over the last 40 years, lifting over 1 billion of the poorest of the poor from abject poverty, which is to say hunger, to being merely poor, which is a wonderful thing. Mm-hmm. And when poor people get more money, the things that provide them utility are disproportionately more commodity intensive. Tom, when you get more money, you buy some little gizmo from Apple, that weighs 7 grams. When a poor person gets more money, he or she replaces a thatch roof with a steel roof, or mud and stick walls with cinder block. They go from barefoot to tennis shoes, to a bicycle, to a 50cc motorcycle, to a Toyota Hilux. All of that stuff is commodity intensive. When rich people get more money, they buy services. So 2 things are happening simultaneously. We are increasing the living standards of the poorest of the poor. We are giving them the ability to compete with you and I for commodities in markets. And the things that they need, unlike the things that we need, are made of stuff. Just think about a family that increases the per capita calorie consumption in their house from 1,200 calories per person per day to 2,000 calories per person per day. I'm not arguing, by the way, for obesity, Tom. I'm just suggesting to you that that works itself through the whole chain. You have to get those commodities to people. You have to package them. Electricity, to store them. It's impossible to overstate the quantum of the gain. I would suggest that the commodities boom that we enjoyed in the decade of the 2000s was due more than anything else to the urbanization of China, to Deng Xiaoping saying to be rich is glorious, which kicked off a marvelous economic boom that took almost 500 million people from rural penury to middle-class existence. And I think that you're seeing that, albeit in slow motion, in Indonesia, in India, in Malawi, in Brazil. And I think you continue to see it for the next 20 years. I think it's a wonderful thing, first of all. But it does mean that you and I, who haven't faced competition for goods from the poorest third of humanity, are going to see increasing competition. Meanwhile, for 30 years, we haven't invested significantly in increasing the supply of those things. So when supply falters and demand increases, it does a fairly predictable thing to price.
You know, Rick, I had a demographics expert on the show earlier this year, and he really changed, or let's say threw a wrench into much of my thinking around how I view this demand picture for many of these markets around the world. So how do you think about the problem of demographics facing many of the developed countries around the world?
Developed countries, I think you have a problem. As people get wealthier, their birth rates fall. The fertility rate actually doesn't fall. The willingness to have kids falls. And so you have major markets that certainly without immigration would be experiencing fairly rapid declines, the United States and Canada being among them. On the other hand, you have continents like Africa, where the population is young and the birth rates are still fairly robust. I think 4.2 children per woman in sub-equatorial Africa, sub-Saharan Africa. The corresponding number in the United States and Canada is probably 1.4, 1.5. Japan, much worse. So I think what you're saying is very true. I think that you're going to see lower levels of material demand in the West, absent immigration, which of course you're seeing. But I think that in terms of the consumption of basic commodities, which is to say basic energy commodities, copper, things like that, foodstuffs, that the increase that you're going to see both per capita and in the number of capitas, which is to say overall population growth, will more than make up for shortfalls in projected consumption in mature markets like Germany, Japan, the United States.
Excellent, Rick. Well, I think that's a good place to kind of wrap up for today. Is there anything, on those topics that you'd like to leave our listeners to think about?
Well, I'll make it easy for them. If you care about the way I think about natural resources, personalize it. Go to my website, ruleinvestmentmedia.com. List your natural resource stocks. And for no obligation, for no charge, I'll personally rank them 1 to 10, 1 being best, 10 being worst. Please no tech stocks. Please no pot stocks. Please no crypto. Leave me to do what I do well. And then, of course, my big event is coming up. The Natural Resources Investment Symposium has been going on for almost 30 years. It happens July 7 through 11 in Boca Raton, Florida. You can attend in person, which is what I would prefer, or via live stream in the comfort and convenience of your own home. 60 hours, of very valuable, very intense programming over 4 days, which means that you will not be able to absorb it all. To that end, we record it all, and you can revisit the recordings, which you'll need to do for a year. Fantastic big picture thinkers, the Jim Rickards, the Bill Bonners, the Nomi Prinzes, the Daniela DiMartino Booths, the Grant Williams. People who tell you about the world the way it is, not the way the big thinkers wish it was. After we've done that, analysts who have made money for investors in natural resources for 3 decades, not retreads from investment banks who failed at technology and got shunted down to resources, but people who operated in resources for a long time. Tom, then we have the living legends, people who have built multi-billion-dollar companies from scratch, talking about the lessons that they learned and how those lessons can make you a better investor, talking about how you take a 50 million market cap company to 3 billion, where the quantum gains are made, giving you some idea of how to catch these, if you will, emerging titans. Importantly, Tom, at my conference, every public company exhibitor, which is where the rubber meets the road, has been vetted. If we don't own stock in them, they can't exhibit.
Mhm.
Very, very, very honest process. No guarantee because I buy a stock, it goes up, but there is a guarantee that the process is honest. All of that put together, Tom, means that whether you attend my conference in person or via live stream, if for any reason you don't think that I delivered, you don't think you got your money's worth, email me. I give you your money back. Full money back guarantee. There's no other conference I know of in the world that can tell you either that every exhibitor has been vetted or that they have a full money back guarantee. So the financial risk around this conference is all mine.
Absolutely. So all of that is available at ruleinvestmentmedia.com and
Ruleinvestmentmedia.com or the rulesymposium.com.
and of course you have now taken to Twitter at Real Rick Rule. Some interesting stuff there as well.
I had a good time on Twitter. It allows me to talk to 40 or 50 million people simultaneously, which is a new experience, for better or for worse.
Absolutely. Excellent, Rick. Well, as always, it's a real pleasure to speak with you, and I really appreciate your time today.
My pleasure. Thanks for the opportunity.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.